Okay, so for today, we're going to have a discussion about equity portfolio management strategies. Now, equity portfolio management strategies are essential approaches that guide investor in managing their equity investment to achieve specific financial goals, balancing return and risk. So, a well-structured portfolio management strategy aims to optimize returns relative to risk through informed decision-making processes. Now, generally, equity portfolio management can be classified into two primary strategies. So, active and passive management. No? So, active management involves actively selecting and adjusting investment to outperform a benchmark, while passive management typically involves replicating a market index to achieve returns closely aligned with that index. So understanding this strategy's distinction, benefits, and challenges is important for aligning them with investor objectives. And to give us more details about the topic, let us all welcome our presenter this afternoon. Go ahead, sir.
Good afternoon po, Doc. Good afternoon po, colleagues. So my discussion is all about equity portfolio management strategy. So on my topic, I would like to make an introduction, importance, how it works, and the different strategies. So when we say equity portfolio management, it is the planning and implementation of diverse ideas, processes, and tactics for defeating the equity market. It involves the selection of monitoring and adjustment of a collection of stocks or equity securities to achieve a specific investment goal. So equity portfolio management refers to the practice of strategically selecting and managing a portfolio equity investment to achieve specific financial objectives. It represents ownership stakes in publicly traded companies, and equity portfolio managers are responsible for making investment decisions that will generate returns for their client and shareholders. So the key components in understanding the equity portfolio management are: first is the investment objectives, which typically establish clear investment objectives based on the goals and risk tolerance of their clients and shareholders. The portfolio construction, which involves selecting a diversified mix of equity investment that align with the investment objectives and risk profile of the portfolio. Equity portfolio managers may use various analytical techniques such as fundamental analysis, technical analysis, and quantitative analysis. Risk management is a critical aspect of equity portfolio management, as equity investments are subject to market volatility and other risks. Portfolio managers employ various risk management strategies such as diversification, hedging, and position sizing to mitigate the risk and protect the portfolio against adverse market movements. Next is the active management, which may adapt by monitoring market trends, economic indicators, and company performance to identify opportunities and adjust the portfolio accordingly. To management's strategies may involve buying and selling security based on short-term market fluctuation or long-term investment teams. Number 5 is performance monitoring and reporting. By They provide regular performance report to clients or shareholders, highlighting portfolio performance, attribution analysis, and any changes made to the portfolio. And last is client communication. To have a effective communication with clients or shareholders, it is essential for equity portfolio managers to provide regular updates on portfolio performance, market developments, and investment strategies to address any question or concern that may arise. So, what is equity portfolio manager? So, equity portfolio manager is a financial professional responsible for overseeing and managing portfolio equity investments on behalf of clients, investors, or institutions. Their primary role is to invest in decisions to maximize the return while managing risk within the portfolio. So it analyzes the financial market, evaluate individual stocks, or construct portfolios that align with the investment objectives and risk tolerance of their clients or shareholders. So, what are the responsibilities of the equity portfolio manager? First is the investment analysis. So, they are conducting an in-depth research and analysis of individual stocks, section, and market trends to identify investment opportunities and risks. Portfolio construction. So, selecting and combining diversified mix of equity investment to build a portfolio that needs the desired risk return profile and investment objectives. Risk management. So, they are implementing risk management strategies to mitigate portfolio risks, such as diversification, hedging, and position sizing. Performance monitoring. So, monitoring the performance of portfolio against benchmark and investment objectives, analyzing the performance attribution, and making adjustment if needed. And client communication, like what I said, so providing regular updates and reports to clients and shareholders. And last is the market forecasting, which is forecasting the market trends, economic indicators, and company performance to anticipate the opportunities and risks and adjust portfolio allocation accordingly. So, equity portfolio management techniques. So, it is a technique encompass a variety of strategies and approaches used by the portfolio managers to analyze, construct, and manage portfolios of equity investment. So, these techniques are aimed to optimize the portfolio performance while managing risk effectively. So, these are some example. There are some common equity portfolio sample. First is fundamental analysis, technical analysis, quantitative analysis, risk management, portfolio optimization, behavioral finance, asset allocation, value versus growth investment, and the active and passive management. So first is fundamental analysis. When we say fundamental analysis, this is the search for stock trading at price higher or lower than the real value. It's a method of determining stock real or fair market value. It involves evaluating the intrinsic value of individual stock by analyzing the factors such as the company financial, earning growth, revenue trends, industry dynamics, competitive positioning, management quality, and economic condition. The portfolio managers use fundamental analysis to identify the undervalued or the overvalued stock and make informed investment decision. Next is the technical analysis. So in technical analysis, a means of examining and predicting price movement sorry, in the financial market by using historical price chart and market statistics. It is based on the idea that if the trader can identify the previous market pattern, they can form a fairly accurate prediction of future price trajectories. So it involves analyzing past market data, such as price and volume trends, to forecast the future price movement of the stock. The portfolio managers use technical indicators and chart patterns to identify the trends, the momentum, support and resistance level, and the potential entry and exit points for the trade. Third is a quantitative analysis. It is an area of investment that employs mathematical methods, probability, and statistical analysis, and data analytic, including techniques from machine learning to develop trading strategies, construct portfolio, and manage the risk. So it involves mathematical and statistical model to analyze the financial data and identify investment opportunities. The portfolio manager uses these quantitative techniques to screen the stocks, develop trading strategies, optimize the portfolio allocation, and manage risk. Quantitative analysis may include factors such as valuation metrics, earning estimate, price momentum, volatility, and the correlations. Risk management techniques. It's analyze the investment return relative to its risk level, with higher risk typically expected to yield higher return. So Risk management techniques are employed to identify, assess, and mitigate risks associated with the equity investment. The portfolio managers use various risk management tools and techniques such as diversification, asset allocation, and hedging strategies to protect the portfolio against adverse market movement and minimize potential losses. Number five is portfolio optimization. Portfolio optimization is the process of selecting and combining different assets with the aim to achieve the best possible outcome in terms of risk and return. It involves using quantitative techniques and analysis of metrics related to the portfolio expected return, correlation, and volatility. So, involved in constructing portfolios that maximize return while minimizing the risk. Next is the behavioral finance. It is economic theory that ascribes the irrational behavior of individuals making financial choices to psychological factor or biases. So this technique incorporates insight from psychological and behavioral economics to understand and account the investor's behavior and market inefficiencies. So the portfolio manager used behavioral finance principle to avoid common cognitive biases, exploit market anomalies, and capitalize the investor's sentiment and market trend. Portfolio, okay, maulit ko po. Next is asset allocation, which is dividing your investment among different assets such as stocks, bond, and cash. It's an investment strategy that aims to balance the risk and reward by apportioning the portfolio's asset according to the investor's goal. So determining the proportion of the portfolio to allocate the equities versus the asset classes like bonds or cash based on the risk tolerance and investment objectives. Number eight is the value and growth investing. So where growth investing seek out companies that are growing their revenue, profit, or cash flow at a faster than average pace. Value investing target all companies priced below their intrinsic value. So when we say value investing, it is seeking the undervalued stock with strong with fundamentals. And when we say growth investment, it is targeting the companies expected to grow at an above average rate, even if there's a current valuation appears high. And last is the passive and active portfolio management. So when we say passive equity portfolio management, it is a strategy used by index fund. In this type of funds, the mutual fund company buy and sell stock to match or approximate a market index benchmark. It is also called an index fund management. So in an investment strategy that aims to replicate the performance of a specific market index or benchmark rather than attempting to outperform it through active trading. So this is because the passive portfolio is typically designed to parallel the returns of a particular market index or benchmark as closely as possible. For example, each stock listed on the index is weighted, that is represent a percentage of the index that is commensurate with its sizes and influence in the real world. The creator of this index portfolio will use the same weight. Okay, so it is a long-term buy and hold strategy, replicates the performance of a specific benchmark to match the market performance. So from passive management, so these are the characteristics: attempting to replicate the performance of an index, advocating the random walk theory, costing often cheaper, and having a strong rationale. So the key features in a passive equity portfolio management, it is the index tracking. So it is the primary objective is to monitor the returns of a particular index. This involves investing in some securities as those in the index, typically in the same proportion. It is low cost, so passive management generally has a lower fees compared to the active management. because it requires less frequent trading and less research. This can lead to a higher net return for investment over time. Minimal trading. So in minimal trading, it's typically involved in a buy and hold approach, resulting in lower portfolio turnover and reduced transaction costs. Next is diversification. When we say diversification, it is an investment in a broad market index. Passive portfolios benefits market efficient assumptions. So passive management is based on the belief that markets are efficient and that it's difficult for investors consistently outperform the market. Simplicity. So when you say simplicity, it is a straightforward, make it easier for investors, making it easier for the investors to understand implementation. And last is the long-term focus. So passive investors usually aim for a steady growth over the long term rather than chasing a short-term market fluctuation. So in index portfolio construction technique, first is the full replication. When we say full replication, it is all securities in the index are purchased in the proportion to the weight in the index. The advantage is first is it is complete data redundancy. So when we say complete data redundancy, replication ensures all systems have identical data, which is critically for backup and recovery. So the drawback of this technique is data inconsistency. So when say data inconsistency, it could arise if the synchronization process aren't well managed and potentially leading to data integrity issue and inaccuracy when making critical business decision. So, sorry. Next is sampling, buying a representative stocks in the benchmark index according to their weight in the index. The advantage of that is fewer stock means lower cost. Reinvestment of dividends is less difficult. And the drawback there is there will be some tracking errors. And last is the quadratic optimization programming. So in this kind of technique, it is a historical data on price changes and correlation between securities into the computer program that determines the composition of a portfolio. So the advantage of that is it minimizes the tracking error within the benchmark. And also the drawback there is because of it depends more on the computer program, historical correlation is leading to a failure to the track the index. So index fund is a fund manager will typically attempt to replicate the composition of particular index the exact securities comprising the index in the exact weight. So here in the Philippines, we have the Philippine Stock Index Fund. So Philippine Stock Index Fund is a mutual fund incorporated in the Philippines. It's a fund. This fund objective is to provide investment return that closely corresponds to the performance of the Philippine Stock Exchange. Philippine Stock Index Fund was incorporated in December 11, 2002 as an open-end investment company. So next is the exchange traded funds. Depository receipt that gives investor a pro rata claim on the capital gain and cash flow of the securities that are held in deposit by the financial institution that issued certificates. So here in the Philippines, we have the First Metro Philippine Equity Exchange Fund. Okay, so it is a domestic corporation engaged primarily in the business of investing, reinvesting, and trading in, and issuing and redeeming its shares of stock in creation units in exchange for a basket of securities representing an index. It was incorporated in January 15, 2013, and same as the other one, it is an open-ended investment company. So next is the um, active equity portfolio management. So the active equity portfolio management it involves an actively selecting and managing a portfolio of stocks with aim to outperforming a benchmark index. So it can be defined as a hands-on investment approach where investors or mutual funds managers actively make an investment decision depending on the prevailing market condition. It's to ensure that the returns from the investment portfolio outperform a market index. The key features of a active portfolio management strategies is stock selection. Are undervalued or have strong growth potential. This can involve fundamental analysis, technical analysis, and a combination of both. Market timing is an active managers may attempt to time the market of buying and selling of stock based on the market condition or macroeconomic indicators. Higher turnover. So active management typically involves more infrequent buying and selling of securities, leading to higher portfolio turnover compared to a passive management. It has a cost structure. So active management generally incurs a higher fees due to research costs, trading commissions, and need for skilled management. Customization, it can be tailor portfolios to meet a specific investment goal or risk tolerance, allowing for more personalized investment approach. Risk management, so active managers actively monitor and adjust the portfolio to manage the risk, which may involve sector rotation or hedging strategies. Performance benchmark, the success of an active management is typically measured against the benchmark index. So managers aim to achieve alpha or excessive return over this benchmark. And last is the investment horizon. So active managers may adopt various time horizons ranging from short-term trading strategies to long-term investment, depending on their market outlook on the investment philosophy. So the sample of active equity portfolio management are value investing, growth investing, sector rotation, market timing, bottom-up stock picking. So in value investing, it is a fundamental research and long-term growth possibilities. This technique actively chooses cheap stock. So it is a strategy where investors actively look to add stock they believe have been undervalued by the market or trade for less than intrinsic value. Like any type of investing, value investing varies in execution with each person. Growth investing is a stock buying strategy that aims to profit from firms that grow at above average rate compared to their industry or market. So active manager target industries like technologies or healthcare in their search for fast growing company with the potential for big financial gains. Sector rotation, it's a movement of money in the stock market from the one industry to another as investor anticipate the next stage at the next stage of the economic cycle. So based on their prediction for a particular market or industry, portfolio manager actively shift investment among various sectors. So market timing, it is a practice of anticipating market lows and market high to buy a sell or sell short stocks exchange traded fund, ETF, or other asset at the most variable prices. Simply put, it is about trying to pinpoint price tops and bottom to optimize your market entries and exit. So the manager shift exposure to stocks, bonds, or other asset classes according to their judgment of the market environment and economic data. The bottom-up stock picking commences by examining the individual companies and progress upward. So this strategy concentrates on the detailed analysis individual companies, scrutinizing their financial statement, management teams, competitive environment, and distinctive value proposition. So the active managers examine a specific business to find the standout performer, ignoring the broad market patterns or the industry benchmark. So let's us differentiate the passive portfolio management to the active portfolio management. So based from the meaning, passive portfolio management is formed by matching the market portfolio, while active portfolio management, it is investing based on the independent analysis of the value of each investment. Objectives to match the trade to track index performance, focus on the relative return, while the objectives of the active portfolio is to beat the market performance, focus on the absolute return. Long-term versus short-term. So in passive portfolio, it ignores the short-term fluctuation as it has been a long-term investment focus, while active portfolio takes advantage of a short-term price fluctuation to beat the broader index. The portfolio composition is all securities of market index held to match market performance, while in active, more concentrated portfolio with fewer securities than broad market index. And flexibility, low flexibility buying and selling based on the changes in the index composition, while in active portfolio, it has a higher flexibility. It involves strategies like shorting, use of derivatives, hedging, leverage, arbitrage, and others. So that's the end of my report. Thank you po.
Yeah. No. Okay, so as our presenter mentioned, passive management is aimed to match the performance of a specific index, such as the S&P or the FTSE, no, by creating a portfolio that mimics, no, the index holding. So this strategy relies on the belief that markets are efficient over the long term, making it challenging for managers to consistently outperform the index. So the main advantages of passive management are its lower costs, its simplicity, and reduced need for frequent trading. So which lower transaction costs and taxes. So passive investing is particularly appealing to long-term investors who seek stable, predictable returns rather than outperformance. One variant of active management is the growth-oriented strategy, where our investor focus on companies expected to grow faster than the market average. No, growth investing often target companies in sectors such as technology and healthcare, no, that demonstrate robust revenue growth, innovative products, or a competitive advantage. So growth stock, no, however, can be volatile, no, as their valuation are often high, no, making them sensitive to market corrections. Investor in growth-oriented strategies typically accept higher risk levels with the potential for substantial capital appreciation over time. Conversely, value investing, no, another popular active strategy, no, emphasizing finding undervalued stock trading below their intrinsic value. So value investor believe that these stocks have potential for price appreciation as the market eventually corrects its valuation. And this strategy relies heavily on fundamental analysis, focusing on financial ratios, no, historical performance, and of course the company or organizational fundamentals. Value investing is often seen as less risky no, than growth investing, since it emphasizes buying stocks at a perceived discount, offering a margin of safety. However, value stocks, no, can sometimes take longer to realize their potential, requiring patience, no, and a long-term overlook. For investor, no, like us, no, interested in reducing portfolio risk, a defensive strategy focuses on selecting stock from sectors less affected, no, by economic cycles such as syempre yung utilities, sabi ko kanina, healthcare, and consumer staples. Na defensive stocks kasi are generally more resilient, no, during market downturns because it provides stable returns even in economic uncertainty. And take note, class, this strategy prioritizes capital preservation over high returns, making it attractive for risk-averse investors or those nearing retirement, actually, katulad ko. No? However, defensive stocks may underperform during strong bull markets, where high growth sectors typically dominate returns. So sector rotation is a tactical strategy within active management, where managers adjust portfolio allocation based on anticipated shifts in the economic cycle. And this approach, involves rotating investment among sectors expected to outperform in the current phase of the cycle, such as technology during economic expansion or utilities during contraction. So, sector rotation, requires deep economic insights, market timing, and agility, making it complex and more suitable for experienced managers. While this strategy offers the potential for high returns, it can lead to higher turnover than at the same time and transaction costs, impacting overall returns. And lastly, a popular passive approach is smart beta, which seeks not to enhance returns by emphasizing specific factors such as yung size niya, yung value niya, yung momentum, or yung volatility, while keeping cost low. Smart beta portfolios apply systematic, role-based approaches to overweight stocks with desirable characteristics instead of solely relying on market capitalization like traditional indexes. And this approach allows passive investors to pursue factors associated with active management benefits such as value or low volatility without incurring high fees. Now, however, smart beta strategies require careful design, and understanding of factor behaviors, as unintended risk may arise if factors underperform. Each of these equity portfolio management strategies cater to different investor preferences, dependence objectives, and risk tolerances. Because again, a well-considered approach involves assessing personal or institutional goals, time horizons, and risk appetite before selecting the most suitable strategy, while active strategies seek higher returns through research and market insights. So passive strategies, again, appeal to cost-conscious investors who value long-term and market-level returns. So again, I believe that by understanding and combining this strategy, an investor can construct their diversified portfolios that align with their investment philosophy, maximizing the likelihood of achieving their financial goals. Okay?